Let me ask you something. When was the last time you saw every major gold indicator light up at the same time? Not just one or two signals. I'm talking about technical breakouts, central bank buying records, commercial short covering, and geopolitical chaos all converging in the same 72-hour window. Because that's exactly what's happening right now, and most people have no idea what they're looking at. Here's what I mean. Gold just broke through a resistance level that's held for 8 months. We're talking about the $2,685 zone that's been capping this market since March. That's not just some random number on a chart. That's a level where billions of dollars in institutional positions were placed. When that breaks, it tells you something fundamental has shifted in how the big money views this market. But here's where it gets interesting. While that technical breakout was happening, the World Gold Council released data showing central banks bought 183 tons in the third quarter alone. That's the highest quarterly purchase in over a decade. And these aren't small players. We're talking about China, India, Poland, Singapore, countries that are actively reducing their dollar exposure and moving into hard assets. Now, you might be thinking, okay, that's bullish for gold, sure. But here's what most analysts are missing. The red signals aren't warning of a crash. They're warning of acceleration. Let me explain what I mean by that. Go back to 2008 for a second. Right before Lehman Brothers collapsed, gold was trading around $900 an ounce. Most people thought that was expensive. The financial media was calling it a bubble. But what happened next? Within 3 years, gold hit $1,900. It more than doubled while the stock market was still trying to recover from the crisis. Why? Because the red signals everyone was seeing, the banking stress, the credit freeze, the emergency Fed interventions, those weren't warnings to get out of gold. They were warnings that the entire monetary system was about to change. And gold was the asset that would reflect that change. Fast forward to today. We've got similar signals, but they're bigger. The U.S. national debt just crossed $36 trillion. That's trillion with a T. We're adding $1 trillion in debt every 100 days now. The interest payments alone are approaching $1 trillion annually. That's more than we spend on defense. Think about that for a second. We're paying more to service our debt than we are to fund the entire military. And here's the kicker. The Federal Reserve is stuck. They can't raise rates meaningfully without crashing the economy, but they can't keep rates low without fueling inflation. It's a trap. And the market knows it. That's why gold is breaking out even while the dollar is relatively strong. That's not supposed to happen, according to traditional correlations. But it's happening because smart money is looking 3 moves ahead. Let me show you what I'm talking about with some specific numbers. The COMEX gold futures market just saw the largest short covering event in 6 months. Commercial traders, the big banks and institutions that usually bet against gold, they closed out 47,000 short contracts in 2 weeks. That's $10 billion worth of positions. These are the players with the best information, the ones who see order flow before anyone else. And they're getting out of the way. At the same time, the gold ETFs are seeing inflows again. After months of outflows, retail and institutional money is coming back in. GLD, the largest gold ETF, added 12 tons in the past week alone. That might not sound like much, but it's the first sustained inflow we've seen since April. It tells you sentiment is shifting. But here's what really caught my attention. The gold to silver ratio just dropped below 84. For those who don't follow this metric, it measures how many ounces of silver it takes to buy 1 ounce of gold. When this ratio drops, it usually means both metals are in a bull market, but silver is starting to catch up. That's significant because silver tends to lag gold at the start of a move, then outperform once momentum builds. Now, let's talk about what's driving this from a fundamental perspective. Because the technicals are one thing, but the underlying forces are what really matter. First, you've got the BRICS nations actively working to reduce dollar dependence. This isn't conspiracy theory stuff. This is official policy. At the last BRICS summit in Johannesburg, they announced plans for a new settlement currency backed by a basket of commodities, including gold. Russia and China are already settling oil trades in yuan. India is buying Russian oil with rupees. The petrodollar system that's existed since 1974 is being systematically dismantled. What does that mean for gold? It means the primary use case for holding dollars, buying oil, is diminishing. And when countries need fewer dollars, they need somewhere else to park their reserves. Gold is the obvious choice. It's liquid, it's recognized globally, and it can't be frozen or sanctioned like dollar assets can. Just ask Russia. which had $300 billion in dollar reserves frozen after the Ukraine invasion. You think other countries didn't notice that? Second, you've got the physical supply situation. Gold mine production peaked in 2018. We're not finding new deposits fast enough to replace what's being mined. The average grade of gold ore has been declining for decades. It now takes more energy, more capital, and more time to extract the same amount of gold. Meanwhile, demand is accelerating. China and India alone account for over 50% of global gold demand, and their middle classes are growing. Here's a story that illustrates this perfectly. There's a mine in Nevada called Cortez. It's one of the largest gold mines in North America. Back in the 1960s, they were pulling gold out of ore that graded 0.3 ounces per ton. Today, they're processing ore that grades 0.03 ounces per ton. That's a 90% decline in grade. They're moving 10 times more rock to get the same amount of gold. And that's with modern technology and equipment. What does that mean for prices? It means the cost floor for gold keeps rising. Even if demand stayed flat, which it's not, the supply side alone would push prices higher over time. But demand isn't flat, it's accelerating. Third, and this is the big one, you've got the everything bubble starting to crack. Real estate is rolling over in major markets. Commercial real estate is in crisis, with office buildings in cities like San Francisco and New York trading at 50% discounts to their 2019 values. The stock market is trading at valuations that have only been seen twice before, in 1929 and 2000. Both times ended badly. When bubbles pop, capital doesn't just disappear, it flows somewhere. And historically, it flows into hard assets. Gold, silver, commodities. Things that can't be printed or created out of thin air. Now, I want to pause here for a second because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, there's something you should know. You can actually move a portion of that into physical gold without taking a taxable distribution. It's called a gold IRA. I put together a free guide that explains exactly how it works, what the rules are, and how to avoid the common mistakes people make. It's in the description below. No obligation, just information. Worth checking out if you're thinking about protecting some of your retirement savings with hard assets. All right, back to these red signals and what they mean for where gold is headed next. Let's talk about the technical picture in more detail, because this is where things get really interesting. Gold is now trading above its 50-day, 100-day, and 200-day moving averages. All three. That's a bullish alignment that typically precedes sustained moves higher. The last time we saw this setup was in late 2010, right before gold went from $1,300 to $1,900 in less than a year. But here's the key level to watch. $2,750. That's the next major resistance. If gold breaks and holds above that level, the technical target based on the current pattern is $3,100. That's not some wild prediction. That's just measuring the consolidation range we've been in and projecting it upward. It's basic technical analysis. And here's why I think we get there faster than most people expect. The options market is showing something unusual. Call options, bets that gold will go higher, are trading at a premium to put options. That's normal in a bull market. But the size of the premium is what's notable. It's the widest it's been in 18 months. That tells you professional traders are positioning for upside, and they're willing to pay up for it. Now, let's connect this to what's happening in the real economy, because that's where the rubber meets the road. Inflation is not dead. I know the headlines say it's coming down. The CPI is lower than it was. But here's what they're not telling you. The CPI is a manipulated number. It's been changed over 20 times since 1980 to make inflation look lower than it actually is. They've removed housing costs. They've substituted cheaper goods. They've used hedonic adjustments. If you calculated inflation the way it was calculated in 1980, we'd be looking at double-digit inflation right now. Don't believe me? Go to the grocery store. Check your insurance premiums. Look at your property taxes. Talk to anyone trying to buy a house. Real inflation, the kind people actually experience, is running way higher than the official numbers suggest. And here's the thing about inflation. It's not a bug in the system. It's a feature. When you've got $36 trillion in debt, the only way to make that manageable is to inflate it away. You can't tax your way out of it. You can't grow your way out of it. The math doesn't work. So you inflate. You print money, you devalue the currency, and you make the debt worth less in real terms. That's what's happening right now. And gold is the market's way of pricing that in. Let me give you a historical parallel that's eerily similar to today. In 1971, Nixon closed the gold window. He ended the convertibility of dollars into gold. At the time, gold was $35 an ounce. The official reason was to stop foreign countries from draining U.S. gold reserves. The real reason was that the U.S. had printed way more dollars than it had gold to back them up. What happened next? Gold went from $35 to $850 by 1980. That's a 24x increase in 9 years. And that was in an era when information moved slower, when markets were less interconnected, when there were fewer participants. Today, we've got instant global communication, 24-hour markets, and billions of people in emerging markets who are just starting to accumulate wealth. If we see a similar repricing event, and I think we will, the move could be even more dramatic. Here's another angle most people aren't considering. The gold mining stocks are still cheap relative to the metal. The GDX, the Gold Miners ETF, is trading at levels that suggest gold is around $2,200, not $2,700. That's a massive disconnect. Either the miners are going to catch up, or gold is going to come down. Based on everything we're seeing, the miners are going to catch up. Why does that matter? Because when gold moves, the miners typically move 2x to 3x as much. It's leverage. If gold goes from $2,700 to $3,500, that's a 30% move. But a well-run gold miner could see its stock double or triple. That's the opportunity here for people who understand the leverage dynamics. But let's get back to the red signals, because there's one more that's absolutely critical. The repo market is showing stress again. For those who don't know, the repo market is where banks lend to each other overnight using treasury bonds as collateral. It's the plumbing of the financial system. When repo rates spike, it means banks don't trust each other. It means there's a shortage of dollars in the system. We saw this in September 2019, when repo rates suddenly jumped from 2% to 10% overnight. The Fed had to step in with emergency lending. We saw it again in March 2020 at the start of COVID. And we're seeing early signs of stress again now. Why does this matter for gold? Because when the financial system gets stressed, the Fed's response is always the same. Print money, provide liquidity, bail out the system. And every time they do that, it's bullish for gold. Here's the thing people need to understand. The Fed is not independent. They can't let the system fail. They're trapped by the size of the debt, the leverage in the system, and the political pressure to keep things stable. So when push comes to shove, they'll always choose inflation over deflation. They'll always choose to print rather than let the system collapse. And gold knows this. That's why it's breaking out now, before the crisis fully materializes. The market is forward-looking. It's pricing in what's coming, not what's already happened. Let me give you one more story that ties this all together. In 2011, gold hit $1,900 and then crashed back to $1,050 by 2015. A lot of people got hurt in that decline. They bought at the top and sold at the bottom. But here's what's different this time. In 2011, gold was in a bubble. Retail investors were piling in. There were gold vending machines in shopping malls. Everyone's grandmother was buying gold coins. The sentiment was euphoric. Today, sentiment is still skeptical. Most financial advisors still tell their clients to avoid gold. The mainstream media still treats it as a fringe asset. Retail participation is minimal. That tells you we're not in a bubble. We're in the early stages of a bull market. The real mania, the phase where everyone wants in, that comes later. Probably when gold is above $4,000 or $5,000. We're not there yet. So what do these red signals actually mean? They mean the market is repricing risk. They mean the old assumptions about dollar dominance, about endless debt, about central bank omnipotence. Those assumptions are being questioned. And when assumptions change, prices change. Gold isn't flashing red as a warning to get out. It's flashing red as a signal that the game is changing. The monetary system we've lived under for 50 years is reaching its limits, and gold, as it always has throughout history, is reflecting that transition. The question isn't whether gold goes higher from here. The question is how high and how fast. Based on the technical setup, the fundamental drivers, and the historical parallels, I think we're looking at $3,500 within the next 12 to 18 months. And if the crisis accelerates, if we see a real breakdown in the dollar or the treasury market, we could see $5,000. That might sound crazy to some people, But go back and look at what gold did in the 1970s. Go look at what it did from 2008 to 2011. Big moves happen faster than people expect when the underlying conditions are right. And the conditions right now are more extreme than they've ever been. The debt is higher. The leverage is higher. The geopolitical tensions are higher. The distrust in institutions is higher. All of that is fuel for gold. So when you see these red signals flashing, don't panic. Understand what they're telling you. They're telling you that the smart money is positioning for a major move. They're telling you that the fundamentals are aligning with the technicals. They're telling you that we're at the beginning of something significant, not the end. The people who understand this, who position themselves accordingly, they're going to do very well over the next few years. The people who ignore it, who stick with the conventional wisdom, they're going to watch their purchasing power erode while wondering what happened. Gold isn't just a metal. It's a barometer of trust in the system. And right now, that trust is breaking down. The red signals are just the market's way of telling you that. Pay attention.